Welcome. This part of the presentation is on capital gains versus ordinary income. Most of you know, my name is Roman Basie. I'm an attorney and CPA. I do tax planning, succession planning, and estate planning across the country for clients, as well as tax return preparation for clients across the country. So let's start today's topic. We're going to talk about the difference between capital gains, ordinary income, and all of the things that come into play when we deal with capital gains, like 1031 exchanges, buying and selling companies, buying and selling assets as a whole. Your clients are going to come to you and say, well, can I get a capital gains rate on this tax issue? And you're going to have to be able to talk about that with them, analyze that to see, is this an ordinary income item or is this a capital gains item? Take a look. Capital gains, I'm on slide 2. Capital gains generally have better, what we call lower tax rates to encourage investment. Now we sit here now, we're producing the 2018 program for the 2017 filing season program. The tax laws may change. They may continue to change over the next 4 years of Trump's presidency. Keep that in mind as you learn about today's tax rates and tax strategies. This is going to be very fluid for the next 4 years. Capital gains generally involve the sale or exchange of what we call a capital item. So I'll use myself as an example. I'm a real estate broker as well. I own real estate. If I sell a building, that is a capital asset. It involves the sale or exchange of a capital item. But if I go into a property and I sell a certain small item in that property, that may not be a capital item for me. It may be ordinary income for me. Wages and labor are usually never capital gains, capital items, of course. Wages are always ordinary for the most part. And what are wages? W-2 income, right? 1099 income, that's what we consider wages. There are some extremely creative ways, though, to take advantage of capital gains. And we're going to talk about that in today's presentation, and you'll see that as well. So we're going to talk about things of that nature. I'm on slide 3. Let's first take a look at our ordinary income rates. So as you see on the top of this slide, I say ordinary. Now what we're showing you on this slide is your married filing jointly rates and your married filing separately rates. And the reason why we're showing you this on this slide is because the next slide we're going to show you shows you the capital gains rates as they apply to these categories. So look at the rate. If you're in the 10% bracket and you're married filing jointly, you can earn income up to $18,650. If you're in the 15% bracket, now the next dollar is what we call the marginal tax rate. So if somebody asks you, what is your marginal tax rate? Or if your client asks you, what is my marginal tax rate? It's that next bracket. So if they make $18,651, it is 15%. Is that their tax rate? No. The first $18,650 is taxed at 10%. The next dollar is taxed at 15%. So their actual tax rate is lower than 15% and much closer to 10%. But it's the marginal rate that most people get curious about. They want to know, when am I kicked into that next bracket, and can I lower myself down into a bracket? So look at 15%. That's $75,900. 25% goes up to $153,100. 28% goes to $233,000, 33% goes to $416,000, 35% goes to $470,000, and 39.6% is $470,000 or more. The proposal, as we produce the program today, the tax proposal in Washington is to limit these down to several brackets and to get rid of these multiple brackets and to remove the 39.6% tax rate. So of course, as tax return preparers, we are all watching the tax law to see what happens, to see if this gets simplified, reduced to 3 brackets, if we lose the high rate of 39.6%.